We are looking at Medical Properties Trust, ticker symbol MPW, sitting at exactly $5.65. The market is currently closed, but the last trading session left us with a massive intraday move of plus $0.33, translating to a significant 6.20% surge in a single day. When you see a real estate investment trust, or REIT, move over 6% in a single session, you are not looking at normal market behavior. You are looking at a repricing event. You are looking at a battleground where the tectonic plates of bearish bets and bullish recovery thesis are slamming into each other. The expectation here is that Medical Properties Trust is a yield trap, a dying giant weighed down by bankrupt tenants like Steward Healthcare, destined to slowly bleed out until the stock price hits zero or is taken private for pennies. The general consensus on Wall Street, and certainly among the loud voices on Twitter and Reddit, has been that this company is uninvestable, a falling knife that will cut anyone foolish enough to try and catch it. But the reality is strikingly different. The reality is that the 6.20% jump we just witnessed is likely the sound of a worst-case scenario being taken off the table. The reality is that the market is waking up to the fact that while the tenants might be broke, the buildings are real, the beds are necessary, and the bankruptcy courts are finally clearing the path for MPW to take back control of its destiny. What we are seeing isn't just a dead cat bounce. It is a potential structural pivot in how this asset is valued. Let's get real about what is driving this price action. You do not get a 6% candle on a boring dividend stock unless someone is scared, and in this case, it is likely the short sellers. For months, MPW has been one of the most heavily shorted stocks on the NYSE. Funds have piled in, borrowing shares through interactive brokers' trading platforms, paying high borrow fees, and betting that the company's debt load would crush it before it could fix its tenant issues. However, when you have short interest hovering near 30% of the float, the stock becomes a coiled spring. Any piece of good news, or even just a lack of bad news, can trigger a scramble to cover. This is the same mechanic we see in high beta names like Tesla stock or Nvidia stock, but seeing it in a hospital landlord is rare. It tells us that the liquidity is shifting. The traders using Robinhood stock trading apps to speculate on a squeeze are starting to align with the deep value institutional investors who are looking at the book value of these hospitals and realizing the math doesn't add up to a $5 stock price if the company survives. We need to talk about the elephant in the room, which is the Steward Healthcare bankruptcy. This has been the dark cloud hanging over MPW for the better part of 2 years. Steward was their biggest tenant, and when your biggest tenant stops paying rent and files for Chapter 11, it looks like a disaster. This is why you saw Schwab Intelligent Portfolios and other automated robo-advisor algorithms dumping the stock earlier this year. The risk models just flashed red. However, look at the recent developments. MPW has reached a global settlement. They have effectively severed ties with Steward. This is the critical turning point. Instead of being held hostage by a tenant who can't pay, MPW has taken back the keys. They have transitioned 15 of those hospitals to new interim operators. Think about what that means. A month ago, investors were terrified that these hospitals would close, leaving MPW with empty buildings and zero revenue. Today, we know that 4 new tenants have stepped in. These are operators who actually want to run these facilities. The company expects these new leases to generate roughly $160 million in annualized cash rent once they stabilize in the fourth quarter of 2026. This is the expectation versus reality gap I mentioned. The expectation was total loss. The reality is a $160 million recovery stream. The market is trying to price that in right now, which is why we're seeing this violent upside move to $5.65. Now, if you're sitting at home managing your own capital, perhaps through a SoFi Invest account, or using Fidelity wealth management tools, you might be wondering if this is a safe entry point. You have to understand the difference between a safe investment and a distressed value play. This is not Apple stock. You don't buy MPW for slow, steady compounding without drama. You buy it because you believe the market has miscalculated the liquidation value of the assets. Let's dig into the mechanics of what happened with the settlement because the details matter. MPW agreed to waive billions in claims against Stewart. On the surface, that sounds bad. You gave up money you were owed, but in bankruptcy, those claims were likely worth pennies on the dollar anyway. By waiving those claims, MPW secured the immediate return of the real estate. They avoided years of litigation. In the world of individual brokerage accounts and self-investing, speed matters. The faster MPW can get a paying tenant into the building, the faster the stock re-rates. They chose speed over a long, drawn-out legal battle they might not win. However, it is not all sunshine and rainbows, and we need to be honest about the risks that still exist. While the Stewart fire is being put out, another fire has started with Prospect Medical Holdings. This is another major tenant that is struggling. In the most recent updates, we learned that Prospect missed rent payments in the third quarter. MPW is now having to install independent directors on Prospect's board to try to force a restructuring or a sale. This creates a whack-a-mole dynamic that scares away conservative money. Just when you fix Stewart, Prospect pops up. If you are using Fidelity investments or looking at Fidelity ETFs that track real estate, you will see that fund managers are hesitant to overweight MPW until they're sure the bleeding has stopped. The fear is that MPW's underwriting standards, the way they vetted these tenants years ago, were too loose. They'd bet on operators who were aggressive, and now those operators are failing in a high-interest rate environment. Speaking of interest rates, this is the macro pressure cooking the stock. MPW carries a significant debt load. They have billions of debt that will eventually need to be refinanced or paid down. When interest rates were near zero, this was easy. Now, with rates higher, the cost of capital has exploded. This is why the stock chart looks so ugly over a 3-year time frame. The market is worried that MPW will have to sell assets at fire sale prices just to pay off bondholders. But here's where the contrarian take comes in. MPW has been selling assets, but not at fire sale prices. They've been selling liquidity centers and joint venture stakes at valuations that are actually quite respectable. This proves that the underlying real estate, the physical hospitals, is still valuable. If they can sell enough assets to pay down the 2025 and 2026 debt maturities, the bankruptcy thesis dies. And if the bankruptcy thesis dies, the stock is likely worth significantly more than $5.65. Let's take a step back and look at what Medical Properties Trust actually does for those who might be new to the name. They are a triple net lease REIT. This means they own the land and the buildings, but the tenant, the hospital operator, pays for everything else: insurance, taxes, maintenance, and obviously the rent. In a perfect world, this is a beautiful business model. You just sit back and collect checks while the tenant deals with the leaky roof or the broken MRI machine. It's the type of online investment that people love because it feels passive. But the flaw in the model is that if the tenant goes broke, the landlord has a massive problem. A hospital is not like an apartment building. You can't just kick out a tenant and put a "for rent" sign in the window the next day. These are highly regulated facilities. Transferring licenses takes months. That is the risk premium you are seeing in the stock today. I want you to pause for a second and think about your own portfolio. Comment below with how many shares of Medical Properties Trust you currently hold, or if you sold out during the panic. Are you holding the bag from $10, or did you buy the dip at $3? I really want to know where the sentiment is among real traders. Now, let's look at the data coming out of the Interactive Brokers and Fidelity trading platform flow. We are seeing a mix of capitulation and accumulation. The weak hands, the people who bought for the dividend and got scared, have largely sold. The volume we are seeing now is driven by hedge funds, distressed debt buyers, and high-risk retail traders. The dividend is another sore point. MPW slashed its dividend. For income investors who rely on investing sites to find high yields, this was a betrayal. But from a financial health perspective, it was the only responsible move. They needed to preserve cash. The current yield is still attractive compared to the broader market, but it's no longer the double-digit trap it was a year ago. It's a rebuilding yield. So, where do we